Good afternoon, everyone. My name is Swati Taneja and as a Training Production Director with Informa, I'm delighted to welcome all our attendees on an informative webinar this afternoon on modeling for provisioning of bad debt under IFRS 9. Thank you all for joining us this afternoon. The webinar will be led by Professor Arif Ahmed. But before I begin, I'd like to give you certain rules for the housekeeping for the next 45 minutes. The slides will be available on our SlideShare page and the link will be emailed to you in the next couple of days. The recording of the webinar will also be made available to download and the link will be emailed to you. All the people who are going to be signing up have signed up or have missed the webinar. The link for the recording will be mailed to you. Please do take the time to complete a post-webinar survey that will pop at the end of the session, and you can always type your questions throughout the session and we will have time allocated in the end for the speaker to address your questions. Just to give you a quick update and understanding of our webinar trainer for the afternoon, Professor Arif Ahmed. He is a chartered accountant and MBA and has more than 25 years of experience under his belt in the area of finance and risk management. He leads a couple of our courses for Informa and is one of the most sought after speakers for his inimitable style of blending concept with application in the industry. With that, I hand over to your webinar trainer for the afternoon, and I hope you enjoy the next 45 minutes to an hour.
Good afternoon, everybody. Thank you, Swati. Thank you for inviting me to host this particular webinar on this raging topic of IFRS 9 and provisioning for bad debts. And next 45 minutes, we are going to talk about the IFRS 9 and this provisioning. And at the end of 45 minutes or around that time, we'll be very happy to look into all the questions that might have come in between, or you may raise it after this particular presentation is over. In fact, when Swati asked me to host a workshop, a webinar, as I'm already in Dubai to host a course for Informa, this was one of the most challenging courses that came to my mind. You really do not have many of those accounting standards who has been in the process of evolution since 2009, and it's been 5 years, it's still being evolved. It started from 2009, saw through certain changes in 2010, moved around to 2013, came about again with certain changes in 2014, and hopefully this time it will be irrevocably mandatory from 1st of January 2018. And why I said irrevocably, because earlier such deadlines were set and then eventually deferred. What makes IFRS 9 and this particular provisioning interesting? Let's look into that. Let me move over to the next slide as I go there. What IFRS 9 does, it classifies financial assets into 3 categories. If you remember, under IAS 39, financial liabilities were already classified. That has been carried on mostly. And the financial assets, they have been classified as measured at amortized cost. There's a small condition there. It says if the business model for holding the asset is to collect the contractual cash flow. Now hold on. Contractual cash flow essentially means that when you bought that particular asset, the issuer of the asset promised you a periodic cash flow. So that's the contractual cash flow. And this cash flow represents solely payments for principal and interest, meaning to say that these are essentially the cost of using others' money in form of interest that is being paid and whatever principal that has been collected, that's been repaid. Nothing else. So if you are talking about any other risk, any other credit risk, any other options coming in there, then the cash flows are not solely payments of principal and interest. The second category of classification is fair value through OCI, which is similar to the earlier one in which I was measuring them at amortized cost, except that the cash flow here could also include the sale of the financial assets. Like in the earlier case, I was not contemplating sell. I had bought it, and contractually, whenever I am supposed to receive the cash flow for principal, I will receive it. And that goes under amortized cost. But the moment I move into fair value through OCI, what happens here is if I get a good opportunity, I can sell the asset. And so the movement therein is fair value through OCI, which essentially means the changes in the fair value would be reflected in the other comprehensive income. And anything else here would go under fair value through PL. So which would essentially mean, and they would be designated at the entry level and would be irrevocable, and fair value through PL would mean any changes in the fair value going high, going down, gets reflected through profit and loss account. So if you look into the difference between fair value through OCI and the fair value through profit and loss, the impact is essentially whether it is having an impact on the profit and loss, or the fluctuations in the profit and loss gets insulated when you do a fair value through the OCI. The concept of expected credit loss, the major change that brings in is, so far we were talking about recognizing an incurred credit loss. But now that has been replaced with the concept of expected credit loss. And this applies to almost anything and everything which is not measured under fair value through PL. Well, the reason is if it is measured under fair value through PL, then any change in the fair value would go through profit and loss, so I don't need to provide anything else for that. And of course, it excludes the equity instruments. And how do I measure this loss? Essentially in two ways. One is I measure it for the expected loss for next 12 months, or I provide for the lifetime of the asset in case there has been a significant increase of credit risk since my first recognition. So if you can get the sense, on my first recognition, I will put in the expected loss for 12 months and then keep on doing that unless there has been a significant increase in the credit loss. But this proves to be too complicated for issues like common trade receivables, contract asset, lease rent receivables, etc. So a simplified approach has also been provided there. The impairment standard is there. So what IFRS 9 does, it provides a single framework for dealing with the impairment across a host of assets here. And how does it go? You see, we have put on a small chart here. I mean, let's say we talk about, is the asset credit impaired at initial recognition? If it is so, then I directly move into the changes in lifetime expected credit loss and I recognize the credit loss. If that is not the case, meaning to say the asset is not credit impaired at initial recognition, the next question we ask ourselves, that is that asset a trade receivable or contract asset with significant financing component or a lease receivable, etc. In that case, if the answer to that is yes, I provide a lifetime expected credit loss provision there. If that's also no, I find out whether the asset is a trade receivable or a contract asset with significant financing component. If that's an yes, we again provide lifetime expected credit loss. If answer to that is no, we ask the final question, that whether there has been a significant increase in credit risk since the initial recognition. If the answer to that again is yes, we provide a lifetime expected credit loss, else we provide a 12 months expected credit loss. So if you can remember this particular framework, you would exactly know what kind of provision we need to put in. And you can see the first two questions are essentially talking about the characteristic of the asset itself, while the third question does not talk about the characteristic of the asset, but takes into account certain macro variables which may cause an increase, a significant increase in the credit risk of holding that particular asset. So how do we look into the 12-month and lifetime expected credit loss? What happens the 12-month expected credit loss is essentially a component of the lifetime credit loss. But what we look into that these are the losses which may incur in next 12 months. Now, are we focusing on the losses being incurred? No, not really. We are focusing on the default events materializing. So that leads us to an interesting question, that even if I have not incurred the loss, but the default event has materialized within the 12 months, what do we do? The answer is you consider it under your 12 months credit loss. Is the trigger that would define whether it would come under the 12-month or beyond that. So one of the critical components in using this concept would be, how do I differentiate between a default event and a significant increase in credit risk? Well, I'll take on this topic in a little while. And I also need to segregate the losses caused by this default which has taken place in next 12 months and from those which would take place after 12 months. So as you can see, when you're foreseeing a default event, you are not only foreseeing the trigger, but you are also trying to find out at what point of time it is likely to happen. And the lifetime expected credit loss essentially is the expected credit loss resulting from all possible default events over the expected life of that instrument. So how do I move away from 12-month to lifetime expected loss? If you remember, the flowchart that we showed you asked that question. Has there been a significant increase in the credit risk? That's the clue. So what we do, we keep on applying 12 months expected credit loss unless the credit risk has increased substantially, significantly, or a special measurement requirement came about. And how do I identify the significant increase in credit risk? All right, the standard says nothing about it. It is left to the judgment of the reporting entity. The only thing that it kind of makes clear is that you cannot align the significant increase in credit risk with the date when the asset becomes credit impaired. Look at the difference. The day it becomes credit impaired is a finality. It is the day when you have actually recognized the loss. But significant increase in credit risk is most likely to happen ahead of that particular date. So look into that aspect. They cannot be necessarily used in the same meaning. The focus again here is not the magnitude of the loss, but again essentially on the increase in the risk of default. Or if the probability of default has increased, that would identify an increase in the lifetime expected loss. The loss given default may or may not increase, that's another issue. If the probability of default increases, the loss given default is likely to increase, or it may occur earlier than what we were expecting. So how do I move between these two? So I keep on providing 12 months expected credit loss provision. You have a significant increase in the credit risk, you move on to the lifetime expected credit loss provision. In case you have a reversal of the transfer conditions, you bring them back. It's conceptually almost like you have the floodgates. So if you have too much of rain on the reservoir, you open the floodgates and pump the water out of it. If you have less water there, you close down the floodgates and allow the water to accumulate there. It works in a similar concept here. Now there is a certain special measurement requirement that has been suggested by the IFRS. It says that the rules will apply on measuring loss allowance and to recognize interest revenue on assets that we have purchased and which are credit impaired at the initial recognition. Meaning to say, if we have picked up an asset which is already suffered from credit loss or is it already credit impaired, then how do I treat them? So what happens here, please note that the credit impaired assets are not essentially only default assets, because default is a defined event. Most of the times the word default would come with a contractual connotation. For example, one may say, if you have not paid me interest, it's a default. If you have not submitted the document, it's a default. If you have not renewed the document, it's a default. So the default can be financial, default can be contractual or legal. Now whereas credit impairment talks about having an objective evidence which may corroborate the default, but it is not necessarily the default. A credit impaired asset need not end up being a default asset. Though it can be, it's likely to be, but it is not necessary it will be. Those objective evidences may turn, the situation may turn around, and a credit impaired asset can again become a good asset. But a default asset remains a defaulted asset, though you may restructure it, though you may have some other plans bought around it, but the fact that it has defaulted remains a fact. So what happens? We have a different kind of treatment with respect of the assets that are credit impaired at the initial recognition, and those which becomes credit impaired after initial recognition. If you remember, those which becomes credit impaired after initial recognition, for them what we do, we create the provision for the 12 months and for the lifetime, depending on what kind of credit risk increase we have seen. In case of a purchased or originated credit impaired asset, right at the initial recognition, we find out the internal rate of return based on the cash price paid and expected cash inflow. Nothing much. You take a spreadsheet, you put on the various dates, what is the price paid, is your minus outflow figure, and then on various periods, you bring in the expected cash inflow, and you find out the IRR of it. Please note, in case you have those cash inflows defined by a date, you have a defined date for the cash inflows and the cash outflows, which are not after equal intervals. In that case, the IRR figure that you will get will be an erroneous figure. In that case, you need to use the XIRR function on your spreadsheet. And the entry that you do accounting wise, you essentially debit the loan asset and credit the cash for the amount that you have paid out. Now at each application date, you use that interest rate, which is the IRR. So on every interest application date, you debit the loan asset and you create the interest revenue using that IRR. Once you receive cash, you debit cash and you create the loan asset. So my interest accrual has taken place at the IRR. And in case you have a reversal of the impairment, or you can expect a larger cash flow coming in, you debit the loss allowance and you credit the impairment gain. So debit the loss allowance, credit the impairment gain for the value of the increased, and you discount it again at the IRR. Because this cash flow, if the cash flow occurs right then the discounting doesn't take place. But if the cash flow is occurring subsequently, let us take an impaired asset of $100, which you picked up at $60 because you thought that's the cash flow going to be. But subsequently a restructuring has taken place, and they said that the $60 that is payable to the bondholders, now they will pay $80, but the payment will come after 2 years. So in that case, that $80 after 2 years needs to be discounted back at the IRR which we had computed at initial recognition. I hope this is pretty clear. If not, just pick up a pen and put those 3 entries on a piece of paper and the whole thing would become absolutely clear. There are simplified measures for trade and lease receivables. Essentially, in short, what they say, you need not go into a very complex kind of calculation like others. Herein, you perhaps create a provision matrix. For example, herein you may say that if there's a short-term trade receivable is outstanding for more than 30 days, you may end up having a 5% provision for that. If it's 60 days, you may have a little more provision for that. If it is more than 90 days, you can have perhaps a 10% provision for that, and that's how you'd go around doing it. So this is what the provision matrix would look like, and you create that provision matrix based on your own past experience. In fact, in most of your organization, most of the short-term trade receivables, this is an excellent way of achieving this. Right. What's a default event? I promised you that I'll come back to default event. Now, default event, a reporting entity, you can use your own definition of default event. Or you can use a regulatory definition if it's there. For example, the banking industry, you can pick it up. But they must be consistent with your entire risk management practice. So if you have a credit risk management practice and that defines an event as a default event, you are obliged to use that same definition for the purpose of your IFRS 9 provisioning. If you're using an external events, you can use the definition used by the rating agencies. But please note, in case of a rating agencies, the default event is defined more by recognizing the contractual obligation than anything else. Or you can also use the regulators like your Basel Committee for Banking Supervision or the Basel Accord, which focuses not only on the current contractual obligations, but also likeliness to adhere to the future contractual obligations. And this definition of the default must be consistent with your credit risk management policies that I spoke about, and should also recognize the difference in the type of assets. A particular kind of type of assets may have a different definition of default. So you need not have one definition of default across all your financial assets. You are free to have different definition for different financial assets. And this definition may have an impact on your expected credit loss. Because, for example, if you consider a default event to be a failure to produce a particular document or renew a particular document, then you will be providing this loss much earlier than if you are defining a default event as the instance when the first contractual repayment is overdue by 15 days. So be careful when you define the default event, but at the same time ensure that the definition of default event is consistent to your credit risk management policy that you may have. Now, in order to implement this, you got to have a small challenge on your infrastructure. Well, you do not have, as we said, one size fits all definition. Your credit risk, significant increase or default, they need to be defined for your own purpose. So you not only look back into the definition, but also look into the relevance of the definition to the reporting entity. Then you talk about provisioning, and the provisioning for bad debt. You look back your past data and base yourself on that past data. And it will be pretty much a tough balancing act to balance between the measurement requirement and the corresponding cost. The more precision you look for, your cost of analysis will go up. So somewhere or other we have to draw a line and say that it can be reasonably measured. Please remember that we are talking about IFRS 9. We are not talking about any other statistical theory, nor are we talking about any other regulatory requirement. So the concept of materiality that we use in accounting still holds here. So unless this provisioning or the accuracy of this particular measurement is extremely material, I can always use an existing model based on my past experience. And you could see that we have even the organizations with a simpler computation mechanism is likely to be affected. What kind of impact are we going to have? Now, the major, if you trying to cover on a single sentence, the major impact is so long I was talking about incurred loss, but from now onward I'll be talking about expected loss, not only for 12 months, but for lifetime. So long I was only talking about a provision that may occur in the next 12 months, but now I am maybe required to provide for the entire lifetime. So you can imagine when there's a transition from the 12-month to lifetime provision, so you're most likely to get a significantly enhanced provision which will have a serious impact on your profit as well as on your capital adequacy. One of the sectors which is likely to suffer the most, if I may use the word suffer, is the financial sector. Now, financial sectors are to provide additional regulatory capital. A non-financial sector, if I have a loss, my capital erosion will take place and I will run the business accordingly. But in case of a regulated business like banking or insurance, if my capital value goes down, I'll have to correspondingly either reduce my business volume or have to bring in fresh capital. And as we have explained earlier, the provisioning would have an impact on your capital adequacy. However, if you look into the financial sector, the major differences between the Basel Accord and IFRS 9 would be, in case of a Basel Accord, one may look into the credit risk at a particular point of time, or they can look into the entire cycle. So depending on whether I'm looking at a point of time or I look into the cycle, the amount of the credit risk provision would vary, whereas under IFRS 9, I'm specifically focusing on a point in time, next 12 months or lifetime. IFRS 9 does not mandate any minimum data requirement for computing your loss given default or your exposure default figure, whereas Basel has clearly mandated such requirement. Default is a defined term under Basel but not under IFRS 9. Similarly, there is no minimum floor for expected credit loss under IFRS 9. But Basel says no matter what, there's a minimum standard provision that we have to provide for it. In case of IFRS 9, the discounting is essentially your effective interest rate, which we compute using the IRR, whereas in case of a Basel 2, it is essentially the weighted average cost of capital that we use. One critical difference is IFRS 9 uses a cash shortfall to compute the expected loss. Cash shortfall meaning what is the promised amount of cash and what is the likely amount of cash. This difference is the cash shortfall. Whereas the Basel uses a format like probability of default multiplied by exposure at default multiplied by the loss given default. In fact, IASB carried out a survey between April and June 2013 to understand the impact of this provisioning model. And they broke them up into two categories, mortgage portfolio and other portfolio. And they found in case of a mortgage portfolio, the transition to total allowance is likely to increase from 30 to 260%, well, under normal economic circumstances. And this ratio could be as high as 80 to 400% in case of a worst economic scenario. And if you're transiting to lifetime expected loss, hold on, then the increase could be as high as 130 to 730%, very high. In case of other portfolio, the transition to total allowance again from 25 to 60%, or 50 to 150 in case of worst economic scenario, or 50 to 140% on a transition to lifetime credit loss, 110 to 210% in case of a worst economic scenario. So how do I use the framework? First step, you estimate the 12 months expected credit loss. Step 2, you estimate the lifetime expected credit loss. Now the reason is because at the point of time when we be required to transit from the 12-month to lifetime expected credit loss, you have to effect the transition. You are not going to sit back and compute the whole part again. The transition will have to be effected from that day. So I need to have both those values with me ready. And the step 3, I will look into the macroeconomic at the firm level information to assess whether any significant increase in credit risk has occurred or reversed. Step 3 gives me the trigger. Step 3 tells me whether I remain under step 1, use the 12 months expected credit loss, or I migrate to step 2, estimate the lifetime expected credit loss. Or if there's a reversal, I bring back from the lifetime expected credit loss to the 12-month expected credit loss. This is critical. So not only you compute for the 12-month or the lifetime, but at the same time you get to look into the transition point. And for the transition point, the department, the risk management department or the finance department needs to develop a dashboard of macroeconomic at the firm level information which will indicate the effective increase in the credit risk. And when I'm talking about firm level indicators, I'm not talking about the self-indicators, but I'm also talking about the issuers of those assets. So we need to keep an eye on them. So you can jolly well understand it needs certain amount of effort there. How do I measure the expected credit loss? Well, essentially you consider an unbiased and probability weighted amount. You recognize the time value of money. You use the information that are reliable, supportable, and it's available to you. And all this you do, you apply them on the cash shortfall, which is the difference between the contractual cash flow and the cash flow that the entity is expecting to receive. So on this value, essentially I put on a probability on each of them. So my expected credit loss is essentially a probability weighted estimate of credit loss over the expected life of the financial instrument. So how do we create this assessment model? To begin with, look into the past performance of a specific asset or a group of specific assets. I mean, for example, if you have a certain kind of exposure, let's take a trade receivable across 30 different entities, you need not identify them across those 30 entities. You can group them together and says that trade receivables within 30 days. Or we can break them up into behavior groups. For example, the percentage of loss on retail loan that are overdue by 60 days. As you can see here, the retail loan is a cohort of specific asset, and I'm using them, I'm classifying them overdue by 60 days. And based on this criteria, we develop a probability of default and loss given default reference table. So I see what are the kinds of assets I have on the row. On each column, I find out the classification, 60 days overdue, on time, 90 days overdue, 120 days overdue, and the matrix that particular corresponding cell would give me the probability of default and loss given default. So I have the probability of default, I multiply my exposure with it, and then I multiply the loss given default to get the provision that I should have. Let us look at this example. Say a company originates a 10-year loan at 1 million currency value with 5% interest that's paid annually. This example is drawn from your ISB publication. The 12-month probability of default and loss given default is 0.5 and 25%. The lifetime probability of default and loss given default is also given 20% and 25%, and the default is expected at the end of 2 years. So how do I find out the 12-month expected credit loss? So the 12-month expected credit loss is essentially total value is 1,050,000. Now hold on. 1 million is my capital. 50,000 is the interest at 5% at the end of the first year. And since it's a 12-month expected credit loss, I have not got the interest. So I multiply the whole outstanding by 0.5%, which is my probability of default, and then multiply the same thing by 25%, which is my loss given default, and I discount it by 5%, which is my interest rate. So I get a value of 1,250. And how do I find the lifetime expected credit loss? Now here it says the default is expected at the end of 2 years. So I have again 1,050,000. Again, look into this. 1,050,000, not 1,100,000. Because the default is happening at the end of the 2 years, which means the first year's interest has been collected by me. So on the first year, there was a 50,000 interest, which was paid. On the second year, again, there's a 50,000 interest, which is not paid. So I take 1,050,000 here, and I discount it back at the rate of 5% for 2 years. That's why you see 1.05 to the power 2. So I take the discounted value, multiply it with the probability. So there comes a probability weightage of 20%. Multiply that by my loss given default of 25%. So I get 47,619 as the lifetime expected credit loss. So at the end of 1 year, if I am looking into a transition from 12-month to lifetime loss, then the difference between 47,619 and 1,250 will have to be provided in the second year. So how do you build your in-house estimation models? And that's likely to be the best solution for most of the organization. The large organizations can always move into expensive credit risk assessment models which are available across the market. There are red vendors. You look into the internet and you'll find a lot of them. However, small and medium scale enterprises who needs to make a provision for them can make a wonderful beginning even by using a common spreadsheet package like Excel. So therein you can create an inbuilt model. You'll use your past transaction data, you relate them to the behavior pattern, and you create an overall matrix related to the probability of default and a provision. So then you create, if the probability of default is 2%, I provide X% of provision. If the probability of default is 5%, this is the kind of provision I provide. So you classify the assets that you hold according to the provision, according to their probability of default, and create a provision matrix out of them. This could be one of the easiest way of providing your provision for 12 months as well as your expected lifetime. And that's all essentially from my side. And we're open to any questions that you may have. I'm here. I won't say all ears, but all eyes looking at your question box. Please feel free to type in whatever questions you may have. Right. I mean, this is a particular topic which is invoked, I should say, a lot of heated debate across the entire accounting fraternity. Not only because it has never been done earlier, but also because conceptually it's something new. The accountants are trained to record events that has taken place in the past. But we're now asking the accountants to foresee events that has not taken place, value them, and integrate them for their current accounting period. That's an entirely different culture altogether. The risk management as a subject, beg your pardon, risk assessment as a subject has not been typically a subject of the accountants, but now the accountants are being asked to do exactly the same. So we can understand why there's a lot of discomfort that's going around. But if you look forward, you are not reinventing the wheel. The banking industry, the finance industry, they have been following this for last few years, particularly under the Basel Accord. And in fact, those of you who are interested in knowing more about the credit risk, I suggest that you look into the website of the Basel Accord, the BCBS, download the publication on the capital adequacy, and look into the credit risk component of that. I think that will be a very great step that you can have. So you can take your time, you can think around, type in your questions, type in your comments if you need something, and we're only happy to respond to that. Yes, Prashant, you can go ahead with your question, please. Please raise the question. Yeah. Yes, you said here we have only trade receivables. I haven't got your question yet. If you please. In fact, if you're talking about the application of the IFRS 9, this is applicable on all your financial assets, right? The methodology of computing is on all your financial assets. You said you have few bounced checks history with the customer. Wonderful, that's a good information. That's a behavioral information. So when you are creating a classification of the customer, from your past you can find out that if you have customers with bounce check history and on what point of time they might have defaulted. And so you can use that as a particular index. So you can create a receivable by saying customers with past history of bounce check, we will provide a provision for 10% or 15% or whatever it is depending on. So on one side you make an analysis, find out the total amount involved with the customers with the bounce check history, and then find out what is the eventual loss arising from those customers. You find that, and that's a relationship you have got, which you can use in future. All right, we have a question is how to deal with the open credit in the short-term aging. Well, that's always a very tricky issue. The open credit is always a tricky issue. What happens, you can take a cue from what the Basel document says here. Now the Basel document says here this open credit facility, which is essentially the unused part of the facility extended to you, that can actually be converted into a credit equivalence. So once you convert that into credit equivalence, and then you use your probability of default or anything else on that. So how do you go about doing that? Again, you go back to the past history. Look into the past history and look into the utilization pattern of the customer. That is, in future, at what point of time the customers are likely to use their open credit facility fully. So you may find out a distribution like this, that 30% of the customers who are currently using 50% of their limit are likely to use 100% of the limit in the next 6 months. 20% of them are likely to use 100% of that in 9 months. Again, 30% of them are likely to use maybe 100% in some X or Y months. So you have a pattern there. Now that pattern will tell you, you can use that pattern to create a credit equivalence factor there. And that's how you can handle it. But that's a lovely question. And in fact, if you look into the IFRS 9, the entire document, you will find ISB has done a great discussion on how to use the open credit. And as I said, you also look into the Basel document and you will find a good relevance there. Look into, or if you are searching up the webpage, you do a search argument as CCF, credit conversion factor, and you'll get a lot of idea from there. There's another question that has come in which says, what if we do not apply rate on the receivables? Well, I haven't got the question. I mean, are you trying to say that you would not provide a provision on the receivables, or you are not classifying the receivables? If you could kindly clarify that. Yeah, this was from one of the participants. If you kindly clarify that, then I think I'll be in a better position to tackle it. I mean, you see the rate on the receivable in one way, which you may be meaning, I'm not very sure. Then one of the ways could be, again, you look into the pattern that of the receivables that you have outstanding on your books, how much of that you are likely to collect within the next period from your past experience. And from there, you discount them back, you find out the IRR. Yes, I have another question that you have a bounce customer who gives a post-dated check of 2 years. Oh yes, post-dated checks. You see, what are the post-dated checks? Post-dated checks are essentially another type of asset that you are holding. Instead of a pure receivable lying in there, the post-dated checks are replacing your receivables through a negotiable instrument which gives you some more distinct legal right. A plain receivable perhaps leads you to one kind of a legal protection, but whereas a negotiable instrument, a liability under a negotiable instrument, the legal system is far more equipped to handle that than an ordinary loan receivable. So when you have done that, you have merely converted one financial asset to another. Everything else that we spoke on IFRS 9 still holds there. Then I'm getting a classification rate for discount. All right, fine. That's what I tried to answer a moment back. Now the rate for the discounting is the whole IFRS 9 is driven by expected cash shortfall. So if I have an outstanding of 100 and I'm likely to collect 95, then my cash shortfall is 95, is a 5%. So what do I do here? Now in that case, I will go back to my own funding cost, which may be akin to my WSCC here. So in this case, since there is no contractual payment, I am unable to identify the IRR in this case. So what I will be using is most likely my weighted average cost of capital, or more specifically, you can use also the terms of your bank in terms of funding your credit stream through a bank overdraft or a clearing account that you may have. But that was a lovely question. There are good questions coming in. You can keep that going. All right. I think thank you very much for the time. Thank you very much for the interaction. And if you have more questions on this, keep them coming. You send them to Informer. We'll pass it around to us and we'll try to get back to you. And if you have further questions, further queries, or you want to attend a program on this, dedicated this particular topic, again, please flag it with Informer, and I'm sure they will be very happy to host such programs here. I keep on hosting programs on IFRS. I'm going to be here to host a program for IFRS specifically for the oil and gas industry sometime later this year. And in addition, there is so many other parts that I keep coming on. How to calculate a provision, I think we just discounted it. Thank you very much, Prashant, for saying that the program has been informative. It's a pleasure to help you all. Thank you very much and have a good time. Bye-bye.